All right, future CPAs, let's get into it. This is a special study guide designed to help you nail one of the toughest topics in cost accounting and actually remember it for the LCPA. So whether you're in your second year or you're a full-on final year warrior, this is for you. Today, we are cracking the code on backflush costing.
You know the feeling, right? Tracking every single work-in-process journal entry. The debits, the credits. As stuff moves from one part of the factor to another, it's such a grind. Super time-consuming, super tedious, and honestly, in today's super fast factories, it feels kind of ancient. But what if? What if you could just skip most of it?
Okay, so here's our game plan. First, we'll look at the old-school grind of traditional costing. Then, we'll jump into the backflush costing shortcut, meet the awesome RIP account, figure out what trigger points are all about, and wrap it all up with a super quick LECPA bullet review to make sure this stuff sticks. Let's do this.
All right, Section 1. Let's set the stage by talking about the before picture, the traditional way of doing things. You probably learned this first. It's that classic, step-by-step way to account for every single cost.
So in this traditional world, every single one of these steps, every single one, needs a journal entry. You buy materials, bam, journal entry. You move them into production, creating that lovely work in process, journal entry. You finish the stuff, you guessed it, another journal entry. You sell it, yep, one more. And it's really that second step, that whole work in process thing, WIP, that just creates a mountain of complicated entries.
But what if you're in a super efficient factory, like a just-in-time or JIT setup where work-in-process inventory is basically zero? Well, for that world, we've got this awesome accounting hack, and that's backflush costing. And honestly, the name kind of gives it away. Instead of tracking costs moving forward, step by step, this system just waits. It waits until the very end, maybe when a product is finished or even sold, and then whoosh, it flushes all the costs backward through the system in one go. The whole point is just to slash the number of journal entries, save a ton of time, and make life way, way simpler.
Okay, look at this. This side-by-side really nails the difference. On the left, you've got the old way, so many separate accounts. But check out the right side. That's our JIT/backflush world. See how it combines raw materials and WIP? And it takes direct labor and overhead and just bundles them together into something we call conversion costs. Basically, all the costs to convert materials into a product. And the kicker? It applies these costs much, much later. It's a total game changer for real.
Okay, so let's zoom in on that first huge change. I'm talking about getting rid of that pesky WIP account and bringing in something way better. So, the big idea is this. Instead of tracking materials moving from the storeroom to the factory floor in separate accounts, we just mush them together. And that gives us the raw and in-process account, or RIP for short. Yep, RIP to the old way. One account to deal with instead of two. How easy is that?
And this right here, this explains the why. You know, in a super fast JIT system, materials aren't just chilling on the factory floor for weeks. No way. They show up, they get worked on, and they're finished goods in maybe a few days or even a few hours. So if your WIP is practically zero, then why in the world would you have a whole separate, complicated account just for it? It just doesn't make sense.
Okay, so we're delaying entries, we're combining accounts, it's all sounding pretty good, but you're probably asking, so when do we actually make a journal entry? And that, my friends, is where the real magic of backflushing happens. Let's talk about trigger points.
A trigger point is, well, it's exactly what it sounds like. It's a specific moment, a specific event, that triggers a journal entry. So instead of doing entries at every single stage, the company just picks the most important ones. Maybe when they buy materials, and when they sell the finished product. Everything that happens in the middle? Skipped, totally ignored for accounting purposes until the next trigger.
So theory is great, but what does this actually look like with real journal entries? It's time for the ultimate showdown, traditional versus backflush. Get ready for that aha moment, because it's coming.
Okay, look at this chart. On the right, that's sequential tracking. Look at all those entries, an entry for every stage. Now, look at the backflush column on the left. Zero in on stage B, record production resulting in work in process. What's it say? No entry recorded. Boom, right there. That is the shortcut in action. We just completely skipped that whole messy WIP entry because we decided that stage is not a trigger point. The costs just get flushed straight from the RIP account to finished goods later. Seriously, this one image tells you the whole story. It's just simpler.
All right, time to lock this knowledge down for the LACPA. Think of this next part as your ultimate study hack. So get your phone ready to screenshot this, or grab a pen, because you're going to want to burn this into your brain. This is your high-speed review.
Let's run through these, quick-fire style. Number 1. It's a shortcut method specifically for JIT systems. 2. It delays journal entries until you hit a trigger point. 3. It completely eliminates the traditional WIP account. 4. It uses that combined raw and in-process, or RIP account instead. 5. It bundles direct labor and overhead into conversion costs. And 6, the big one, the whole goal is to simplify everything by cutting down the number of entries you have to make. Makes sense, right?
So if your brain is full and you can only remember one thing from all of this, let it be this. Backflushing is all about saving time. That's it. It does that by ditching the need to track every single cost as it moves around the factory floor. It's a lean accounting approach for a lean manufacturing world.
And finally, to get you thinking for those tricky analysis questions on the exam, now you know the shortcut, right? So let's flip it. When would this super simplified approach actually be a terrible idea? What kind of company would crash and burn if they couldn't track their WIP in detail? Thinking about that is what's going to make you stand out. All right? You got this. Good luck with your studies.